if our forecasts on growth and inflation remain where it is, that growth is likely to slow, inflation is likely to be moderate, then there is ample monetary policy space to cut rates. And I think the RBI is communicating to markets via the various mechanisms that they have announced, various instruments, OMOs, BRRs, etc., the FX swaps. So given the multiple instruments that they are using, to communicate to markets, to telegraph to markets that RBI is going to provide ample, sufficient, adequate liquidity in the system, whatever is needed in the system. So that I think will enable transmission. If, as you're saying, markets or banks front run this and actually reduce rates faster, that's actually good. At a point where when the interest rate cycle is coming down, where interest rates are sought to be lowered, at that point in time, a surplus liquidity condition is necessary for transmitting lower interest, the policy repo rate into lower lending rates or deposit rates in the system.
Hello and welcome back to Tracking Trends. On April 9, the Reserve Bank of India cut the repo rate, the benchmark interest rate for the economy, from 6.25% to 6%. It also announced a shift in its stance from neutral to accommodative, which means the Reserve Bank of India is now looking at a softer or softening interest rate regime. Thirdly, it also revised the growth target for the current financial year, FY 25-26, from 6.7% to 6.5%. Now, on 23rd of April, that was last week, the minutes of this meeting of the Monetary Policy Committee, which makes this decision, were made public. And there were many interesting observations, many interesting details that kind of outline the rationale behind the decisions that were announced, that also gives us a sense of how the country's central bank is thinking, how the members of the Monetary Policy Committee, which comprises the best of economic minds and monetary policy experts, how are they looking at the prospects of the Indian economy in the coming quarters or months? How are they weighing the risks that have risen from because of various global developments? And we thought this episode of Tracking Trends should focus on getting into the details of this rationale, because they tell us how one should expect things to pan out in the coming time. And to do that, we are very fortunate to have with us today Mr. Saugata Bhattacharya. He is a independent member of the Monetary Policy Committee. Saugata is a former Chief Economist of the Axis Bank. And thank you, Saugata, for making time for us. And let me start by asking you, what, in your view, was the biggest trigger for a rate cut when the MPC met?
So, yeah, first of all, good morning, Rajesh. Thank you so much for having me on your Tracking Trends podcast show. It's a privilege to be here. Let me begin by saying at the outset that whatever I say are my own personal opinions. This does not in any way reflect MPC deliberations. These are my own views that I'm presenting. So the first thing, that the question that you asked, what was the key reason for cutting the rate in the policy repo rate further from 6.25 to 6? This was the second cut after February. Was a basic comfort on the path of inflation. So from the forecast that RBI has generated and the other fundamental macro financial factors that are characterizing the global and domestic environment, it does seem to suggest that the RBI's 4% average CPI inflation forecast for FY 2026 is likely to be realized. If anything, it might actually be lower than 4%. Number one, of course, from the global side, is that the prices of crude oil are likely to remain low. So the average forecast was $70 per barrel. It's likely to be lower than that over the course of the year. Prices of industrial metals are likely to be more moderate because given Chinese growth slowdown, all the fears, as you've seen, later on from the IMF's the global forecast that global growth is likely to be slow, so industrial metals prices are likely to be lower. From the agricultural side, now we are understanding that we are probably likely to get a normal monsoon. El Nino conditions are neutral. So from multiple dimensions, we got the sense of comfort that inflation was likely to be moderate or low over the course of the year. Of course, this comes with that caveat that if the tariff impositions and retaliations continue over the course, I mean, as the US has indicated, so there might be short-term supply chain dislocations that might push up prices, inflation in the short term. But given in the medium term, given expectations of a slowdown, you've seen yesterday China's economy, the U.S. economy actually been has grown in a negative direction in the first quarter. China's growth remains in a slowdown, as you've seen in the numbers before. That it does seem that the growth inflation balance. So growth probably will need to be supported because the global growth slowdown will inevitably, in some manner, spill over into India, as has been seen in the downgrade of India's growth numbers initially by the Reserve Bank and then recently from the IMF. So, given this and with moderate inflation, I think this opens up significant monetary space, the monetary policy space for easing, and that was the essential reason for the rate cut.
Yeah. So as the RBI governor, Mr. Sanjay Malhotra, said, this policy is geared towards stimulating the economy through softer interest rates. And he also further went on to say that while global trade and policy uncertainties shall impede growth, its impact on domestic inflation, while requiring us to be vigilant, is not expected to be of high concern. Is it then? I mean, would it be right to infer all that you listed in terms of prices that are easing? They could more than offset any pressure on inflation rate by way of it being imported. Is that kind of the implicit understanding that MPC has?
Yes. So you're completely right. You put it very succinctly that whatever domestic pressures might emerge, uh, global factors, the global macro price factors are probably likely to pull prices lower. In addition to all the other things that I mentioned, of course, I mean, the government is very aware of this, it's actively monitoring. There is the additional fear that dumping, importing prices below cost from some countries might also lead to easing pressures. This is not good for output, this is not good for the economy. But from the prices point of view, this is yet another factor other than the ones that I mentioned that might actually keep prices lower, more moderate.
Yeah. But they could also have an adverse impact on growth also. I mean,
Yes,
primarily when you talk about dumping.
absolutely.
Yeah.
Yeah, it's going to have an adverse impact on growth. So, given the growth inflation balance as a measure of the sum total of the factors that I mentioned, leans towards the need to support growth, keeping in view that price pressures are likely to be moderate.
Yeah. So, in the minutes of RBI, which were released last week, one noticed that while there was unanimity about rate cut, but in terms of the shift in stance from neutral to accommodative, you had some initial reservations. Uh, and then you came on board after certain clarifications were made. Could you take us through that?
So, first to say that the view on changing the stance was also unanimous. So, I mean, we did not vote. The committee did
Yes.
not vote this time,
Yeah.
but it was unanimous that the stance be changed to accommodative. The initial reservation that I started with was my prior notion that a neutral would give us the space to move in whichever way, raise rates, keep it, hold rates, or cut rates. So at that point, I mean, the growth inflation balance that we talked about, I think the necessity of a move to raise rates at this point, not just this point, in the foreseeable future, I think that the probability is very, very low. The conditions that might necessitate a need to raise rates is minimal. So and then during the discussions, and as governor, if you remember, during his statement on the 9th, post the policy meeting, had devoted 2 paragraphs in his statement to explaining the change in stance. So it was very clear that the accommodative stance also meant that there was freedom to pause if the necessity so arose. So that was enough for me, because remember, you've seen multiple central banks. So pause, Federal Reserve, the Bank of England, the Reserve Bank of Australia, many central banks have actually paused, because given the sheer uncertainty that pervades the present and the evolving macroeconomic system, so that part was essential. One of the key reasons, because I mean, if our growth inflation balance trajectory that I just mentioned is actually happens in the direction of travel that I've indicated, the only reason for pausing might be problems on the external side, on the external
Correct.
front, yeah, which probably would need a pause in the currency. Even there, the conditions for doing that are relatively weak as of this point in time. The dollar has weakened significantly against the other major currencies, so it's not going to be a pressure from that side. China, that was the other fear, that that China might try to weaken its RMB, the Chinese yuan, to counter the problems with tariffs, etc. Even there, what we have seen, the recent fixes in China's currency, does not seem China's currency is actually strengthening. So, given all of this, the need for a pause, even that has come down. But the stance, the accommodative stance, does give the committee, and me particularly, the space in order to be able to pause if necessary, if the need arose. That
Yeah.
was enough. That was enough. I
Yeah.
completely agree with the other members that it's time to shift to neutral. Because remember, the direction of travel is lower in
Yeah.
whether it happens at the next meeting or the meeting after that, the direction is towards lower interest rate. That's all
So,
that is indicated.
yeah. So when you were expressing these concerns, were they more about the first order impact on trade flows or the second order effects on investment and sentiment?
So there are multiple factors on the external front, because as you've seen, before the meeting itself, the WTO had come out with their forecast of a lower trade growth. After that, I mean, multiple organizations, IMF, WTO, etc. WTO has actually lowered the forecast rate of growth of global trade significantly, by almost a half percentage point. So it's now predicted to contract. Global trade is predicted to forecast to contract in 2025. So given this, there will be some spillovers into India. There's no doubt, because I mean, the IMF has forecast a lower global growth, etc. So all of that will lead to some weakening of growth. From the trade front, it's difficult to predict how the current account deficit, the trade deficit will move, because I mean there are multiple external factors and domestic factors. One, of course, from the external side, there is this fear of dumping, which might increase imports into the country. The government has indicated that it's ready to put in place various duties to try to control unwarranted imports into the system. So we are there, but I mean there still might be some pressures from imports. On the domestic front, it's difficult to predict at this point in time, because remember, if growth slows, how households respond to this global slowdown Will they reduce consumption? Will they reduce their savings to keep consumption intact? Will consumption coming in, if imports are coming in at a lower pace, will households consume to the extent that they had done? That reduces savings. And remember, investments are likely to be lower from the capital account side, from the domestic front. Given this uncertainty, private sector will be inclined not to invest to the extent that it has indicated in the past, that it has done in the past. So from that side, and then the actual finances to finance the investment, FDI flows, FPI into equities, shares, stock markets, those might be lower. So, given all of this, that's the uncertainty. There are so many moving parts in the external balance. Remittances, which is part of the current account. So, if global growth in the developed markets, from which we get a significant amount of FDI, remittances. So, if that actually slows down, those remittances from the US, Europe, etc., that might slow. With given the lower oil prices that we have, that is forecast, remittances from the Gulf countries might actually slow. So that's yet another negative. So there are multiple moving parts, and this is the one that I think augments the sense of a slowdown that might emerge from the domestic economy.
Right. Now that there has been a shift in stance from neutral to accommodative, how do you see the role of this stance evolving in the Monetary Policy Committee's communication strategy? Is there a room for a more explicit forward guidance framework within the RBI?
Well, the stance essentially is one instrument of forward guidance. Right. So the accommodative stance indicates, as I said before, that future actions will be towards reducing rates. Right. How much, at what pace, etc. That depends on the incoming data, and that will be decided. To my mind, that will be decided on a meeting-to-meeting basis. What are the present conditions, etc. If our forecasts on growth and inflation remain where it is, that growth is likely to slow, inflation is likely to be moderate, then there is ample monetary policy space to cut rates. We do not expect at any point in time for the policy rate, and hence across all interest rates, to be so low that, I mean, it pushes demand to the extent that we begin to approach potential output, potential growth, etc., which begins to then fuel inflation. I think we have a long way to go before we reach that point. There are multiple analytical studies from the Reserve Bank of India which shows that the repo rate can go anywhere between, say, 5.1, 5.2%, all the way to 5.7%. And given all the problems that we see, the supply chain dislocations, etc., that we see emerging from the global side, at least, I would lean towards the lower end of the band. That, I mean, at this point in time, there is ample evidence that monetary policy, in association with all the other policies, fiscal policy, trade policy, industrial policy, agricultural policy, etc., for monetary policy to need to support growth, to need to provide a stimulus to growth via the credit channel. So credit to MSMEs need to be credit to MSME should be at a lower interest rate, because I do think that MSMEs play a fairly high interest rate, and that needs to be reduced. So I think there is ample space for reducing interest rates at this point.
So let's hope that you have a good monsoon. Let's hope that Trump calms down. Let's hope that some more sense comes into all the key players in the global arena. Then we could probably not necessarily have to pause, and in the next meeting of MPC or the next meeting thereafter, there could be a good opportunity to take a generous look at interest rates. Let's hope. So
I absolutely agree with you. I'm quite confident from whatever we have heard from the US Treasury Secretary, from President Trump himself, that India will be able to sign a trade deal, which will necessitate not lead to higher tariffs. So I think I'm very hopeful of that. That going forward, that we will actually get a trade deal with the US.
Now let's move to the other side of the story beyond rate cuts. Liquidity is also the other dimension, the big dimension, which kind of determines the effectiveness of monetary policy in supporting growth. Now, what do you have to say there? Do you see a risk of transmission breakdown if markets kind of front run the easing path too aggressively?
No. So again, I mean, liquidity is not in the ambit of the Monetary Policy Committee. But liquidity does play a very important role in the operationalizing monetary policy, because monetary policy at the end of the day is all about transmission into interest rates. I mean, if rates are all the repo rate, policy repo rates are getting cut, but it's not impacting lending rates or deposit rates, etc., that means there's a problem somewhere in the transmission. I think this view on liquidity. Remember that governor had explicitly stated in the previous meeting, in his post policy interactions with the media, that he was comfortable with a liquidity surplus of around 1% of total deposits, what is technically called NDTL, net demand and time liabilities, which are essentially deposits. So he's comfortable with that. And I think the RBI is communicating to markets via the various mechanisms that they have announced, various instruments, OMOs, BRRs, etc., the FX swaps. So given the multiple instruments that they are using, to communicate to markets, to telegraph to markets that RBI is going to provide ample, sufficient, adequate liquidity in the system, whatever is needed in the system. So that I think will enable transmission. If, as you're saying, markets or banks front run this and actually reduce rates faster, that's actually good. Yeah, we need a front loading of rate cuts into lending rates or deposit rates, etc. So that's actually good. If banks, NBFCs, other financial intermediaries cut the rates faster than what the repo rate is signaling, that's actually good. Remember, for some time, the short-term call rates, other the very, I mean, 3-day rates, 7-day rates, etc., had actually moved closer to the SDF, which is 25 basis points lower than the repo rate. Yeah, it's again beginning to move towards more towards the repo rate, but it had actually come down. So the borrowing cost, short-term borrowing costs, which banks need to maintain the structural limits. I mean, 1-day limit, 7-day limits, etc., that RBI prudential norms dictate. So that actually reduces rates in those buckets closer to the SDF rates. So even lower than the repo rate. So which is actually good. So that enables banks to transmit the rates. Number two, also remember that about 62% of total loans, bank loans, are now priced at what are called EBLR, external benchmark linked rates, which is essentially linked to the repo. Yeah. So if the repo rate is cut within a very short period of time, almost instantaneously, banks will cut their lending rates that are linked to that EBLR by another 35 basis points. So that's an instant transmission. It's the other MCLR, the marginal cost of lending rates, MCLR base, which RBI's liquidity moves are being signaled that the banks have the space now to cut the MCLR. That's about 90% of all loans in the system. So I think initially we had heard Deputy Governor of RBI mention that transmission usually takes about 2 quarters into the system. My own sense is this will be much faster. Transmission, full transmission of the repo rates will be much faster into lending rates in this round.
So there's a lot of technicalities that you have explained, but for the layman, so by the time the festive season comes, should he be hoping for a much significantly, not, I mean, an appreciable decline in home loan rates or auto loan rates or consumption loan rates?
I remain completely confident in that. I remain completely confident in that. Of course, I mean, this is contingent on the growth inflation balance. I mean, growth slowing down, inflation remaining moderate. If that remains there, I mean, as I mentioned before, there is space for further cuts, and the further cuts will at least very, very quickly translate into home loans, other loans. Remember, all retail loans, home loans, personal loans, automobile loans are now priced at EBLR. All MSME loans are now priced at EBLR. Yeah. So if the repo rate is cut by 50 basis points, 100 basis points, whatever, I mean, we don't know about that. Home loan, the retail guys, I mean, all of us, individuals, we'll see an instant transmission into the lending rates.
Does that happen always now? No, not
Yeah.
with.
Oh, that's the way. That's the reason why the EBLR was actually announced. It was actually formulated that with MCLR, it was found that it became a problem because it was taking too long a time to transmit into rates, and that was the reason that EBLR was put in place.
So I'm asking you this question not as a member of the Monetary Policy Committee, but as an economist. Uh, how do you see this RBI's current liquidity management? Is it calibrated more for transmission or for financial stability? Are these conflicting objectives to pursue, or can there be a convergence?
No, yeah, I don't think there is any major concern. Of course, I mean there are one or two instances that there might be some financial accident, but I think the probability of that is very low. I know where you're coming from. That if liquidity is surplus in the system, banks might try to push retail loans more. So that might at some point in time, if there are problems with underwriting, with risk management, etc., that might create problems. But I think the probability is very low. I think the intent of keeping liquidity surplus at this point in time, go back to the previous cycles. So at a point where when the interest rate cycle is coming down, where interest rates are sought to be lower, at that point in time, a surplus liquidity condition is necessary for transmitting lower interest, the policy repo rate into lower lending rates or deposit rates in the system. So that's a given. The only little problem, only little concern that I would have at this point in time, from a depositor's point of view, as banks cut their lending rates, they will also begin to cut deposit rates. So that is a balance that needs to be maintained, because people who are retired on pensions, etc., interest rates are their major source of income. So from that segment and other segments as well, I mean, earning people who put the money in deposits, fixed deposits, etc. So that's the only thing that might need a little balance from a lending point of view. And I think lending is for lending rates, the rates at which loans are given, much more important, particularly from the MSMEs, because if you need to stimulate growth, that's the segment that needs lower interest rates. So I think overall, the surplus liquidity condition is actually required at this point in time in the rate cut cycle.
Okay, this is going to be my last question because I think we are running beyond the permitted time. I mean, not that. I wanted to bring you to the role real effective exchange rate plays in the growth inflation trade-off. So, can you elaborate your views? How do you see it?
I think that the real effective exchange rates in general, I think that's enough material for two more shows on your.
Yeah, it's a little complicated, but in a very simple way, if you could.
So
briefly.
Exchange rate, basically, in simple terms, the lower, I mean, a weaker rupee is supposed in theory to enable greater competitiveness for Indian exporters, which might enable them to compete with our peers, say ASEAN countries, Vietnam, Cambodia, etc., to be able to be able to compete with them in our exports. It's far more complex than that. So because at a time when the rupee is weakening, so might actually the Viet Dong, the Vietnamese currency, so might actually the Cambodian currency, the Thailand baht. So that relative competitiveness is a dodgy situation. I mean, you need to be very careful on what the drivers of a weaker rupee are. India is no longer like we were in 2013, if you remember, when we were part of the so-called fragile five countries. Our macro situation is very robust now, very resilient. I mean, we are not coming in there from a position of weakness. It's a question of the dollar move, the Chinese yuan, etc. What is driving these currencies? Because remember, the real effective exchange rate that you're talking about is India's rupee against a basket of currencies, not just the dollar.
Just the
So,
dollar.
I mean, if the dollar strengthens, automatically the other baskets, other currencies, the euro, the British pound, the Chinese yuan, the Swedish krona, the Swiss franc, etc., all of them will weaken against the dollar. Yeah. So, I mean, it's a very complicated situation, but in terms of the weakness of the rupee against the dollar, which is the simplest way to understand the currency, your exports become more competitive, but at the same time, your external debt, many companies had raised external commercial borrowings, etc., those become more expensive. And there is the fear of a weaker currency pushing imported inflation. So, because whatever we import, including oil, becomes more expensive if the rupee weakens. So, you import a lot of inflation into the country. So, how the total the balance between the push for exports and all the other negative consequences of a weaker currency, that will begin to play into the system.
Okay, I think we have covered a wide range of issues. I think our audience would be very happy to, watch the way you have touched upon so many critical issues. And my request before I conclude to all of those who are watching this, if you like it, subscribe to our channel, keep coming back to us. You seem to be very optimistic about the way things are going to pan out. You said it appears that the Reserve Bank of India has done the best it could do in terms of making monetary policy supportive of the growth imperatives. Having said that, you also took on board the kind of uncertainties that we are facing, that not everything can be predicted. There is still a lot of tightrope walking that remains for authorities at Reserve Bank of India, for people who manage fiscal affairs of the country, people who spearhead our trade negotiations. Thank you very much. We end by hoping that the best of outcomes should follow. And once again, thank you for your time.
Thank you so much, Rajesh, for having me on your show. Thank you so much.